If you have watched previous video, which was about trading Euro USD to the long side, you must have understood that the idea of that trade was more about selling US dollar for an anticipated correction in the US dollar. So the question is why we chose euro, and this was answered in that video. So I suggest you to watch that video to understand why we chose euro to trade against dollar. And the commodity traders and the gold lovers have been asking why we shouldn't choose gold. Yes, of course, we can choose gold over euro and over any other instrument if we really want to go against the dollar. So yes, gold is the best thing to buy against dollar because of the fundamental reasons. So you can see this monthly chart of the gold, and you can see that it has been going to the upside furiously since the middle of 2022. So once the economists and analysts figured out gold as the best safe haven after Russia-Ukraine war started, and it actually prolonged, the gold actually proved to be the best safe haven. If you do not understand safe haven, you will not understand what I'm talking about. That's why uh, you should first figure out which assets are called safe haven and why they are called safe haven. For example, Swiss franc and Japanese yen used to be safe haven, but they lost their safe haven status in the last 2 years because of the problem of supply of oil and gas from the Russia after this war started. And this not only affected European Union's or Swiss economy or uh, Japan, it also actually affected US because US is funding this war because US is directly supporting Ukraine, and that is also that is impacting even US economy just like any other economy. So dollar used to be, and dollar is still is the safe haven currency. However, its status as safe haven is not as safer as the gold in today's scenario. And this war is not the only reason. There is another geopolitical tension, which is a Hamas war, and Israel is being directly supported by the US. All of these two things together is making dollar the not the best choice, and that's why gold has been rising even against dollar, and of course it has been rising against all other instruments of the world. So I mean, not all other instrument I can say. I don't want to guess anything, but of course gold has been rising against all other currencies. For example, euro, pound, or whatever currencies are majorly traded. So if you want to go for gold, this is the right time to go for gold because a correction to the downside has been seen in the gold. And while dollar will correct to the downside, gold will rise, obviously. And we have a clear double top resistance around 2700, 2722 area, which will be the target. And the idea of exit in loss here will remain the same as the idea of taking loss in Euro USD, which is all about waiting for the closing of the candle. So if closure happens below this low, then you'll have to get out of this position with the loss. Otherwise, you can target 27 even or 27.22 in the gold. Setup on this daily time frame of gold is not something similar to the setup of Euro USD. Euro USD had a double bottom. However, we do not have double bottom. But scenario for gold is even bullish because the second swing to the downside couldn't even reach this bottom, which is even more bullish. So even though we do not have double bottom, it's even better bullish scenario. And if we look at the midpoint and the 100% accurate technical scenario, yes, the last three candles actually is accurately making something like three inside up or a morning star or something like that. So yes, we do have this candle pattern which is suggesting a bullish price action supported by the poorer PCE and everything which was mentioned in that video. We are not reanalyzing here. We are just changing the currency from the instrument from Euro USD to XAU USD or gold, and this is the target. If you want to do the multi-position trading, you can plan for multi-position. For example, you can set a target uh, in one trade at 2700, in another trade at 2722, and we can you can also enter multiple position in case you see a little correction to the downside here. Let's say market goes down a little bit, and you get a better price to enter another long position. So you can enter slightly below. And then if it progresses to the upside and as it strengthens further, let's say if it goes above this area. So this move to the downside was caused by the hawkish FOMC press conference. What is hawkish FOMC press conference? Uh, Actually, US is going to cut the interest rates slower than anticipated. And this has been revealed recently in the FOMC press conference. And that is why it is being called or mentioned in many articles on the internet as hawkish FOMC press conference. So even though there was a cut of 25 basis point in the interest rate from the US, the whole event actually turned to not be bearish, rather it turned to be bullish because of slower pace of further interest rate cut. And that's why there was a downside move in gold or anything versus dollar. So if market goes to the upside and totally erases this move, if it goes above this point, it means it clearly shows that strength of bulls are enough to go beyond it, and then you can even add more positions. So idea of adding more positions is not all about you should add more buy positions when market is falling. You can add more buy positions if when market is rising, because you are adding when you are finding even more strength in the market. So it is like a reaffirmation of bulls and their strength. So how we can do this is all about understanding the sequence of trade formula, which is nothing but algebra. So you can go to our website 25noobsters.com, put your pointer on education in the site menu, do not click it, use a computer not phone, and then you'll find um, strategy details under the submenu. There you will find multi-position formula, how we should plan for the multiple positions with a limited and pre-planned risk. You shouldn't crazily open a number of positions without accurately figuring out how much you are putting on the risk. And that formula is all about figuring out the accurate amount we are putting on the risk before we plan for the multi position. So that's all in this video, and thanks for watching.